Okay, traders, let's move on and take our discussion of volume to another level. So far, we have been isolating our discussion to the volume histogram, which is volume, so that is directly volume. Now, however, we're going to move beyond that, and we're going to start talking about some volume indicators. So the first indicator is very simple. It's a moving average of volume. So just like we have moving average of price, and we use the 15 exponential, the 50 simple, 100 simple, and 200 simple, I also like to use a moving average of volume. Now, kind of standard, I guess, the number I hear a lot is people use a 50-period moving average, and I guess it's the simple moving average of price. And that's what I've got plotted on here right now. Now, what you'll notice is that it just provides basically a horizontal line, but that line doesn't really change a whole heck of a lot, does it? It's pretty close to the same level all the way across from left to right. Very, very small variances. And so that's okay, and if you want to use the 50-period moving average, no problem. But I prefer to use the 20. So now if you'll notice, when we put the 20 in there, all of a sudden it does create more of what we're used to when we see moving averages. So here the moving average actually is going up. Now here it goes pretty much sideways. Here it declines a little bit. Here it goes back up. So for me, again, I don't think it's a huge issue. In fact, it's not a huge issue. But if you're going to use a moving average, hey, why not have it actually fluctuate a little bit in relation to volume, as opposed to using such a long-term one that will just pretty close just draw a horizontal line across the volume subgraph. So that's why I use 20. And then 2, and there's really not much significance to this, but if we're using a daily chart, as I usually do for swing trading, there's roughly 20 trading days in a month, and so 20-period moving average measures a month of average volume. And again, is there any huge significance to that? Not really, but it's a nice round number. The main thing is you do get some movement here where it angles up and it angles down rather than just the straight line. Okay, so now how do we use it? That's the main issue. Well, you saw me before drawing my little rectangles, and you know, like this. And so that's fine, but this is kind of a way of just having a line on there for you already that provides a reference point for the volume histogram. As I mentioned, reading volume can be a little tricky, just like reading raw price bars can be a little tricky. So when you put a moving average on price bars, it just gives you some reference points. And it creates some more meaningful structure that the eye can be drawn to. And that seems to be very, very helpful for a lot of people to get a feeling, a sense of, okay, what is this market doing? I know it certainly does that for me. And so that's the exact same purpose in putting a moving average over volume, is to provide a reference point and a little bit of just obvious, you know, here it is, in your face type of structure. So there's basically 3 things that we can look for, and again, the volume moving average as the price moving average is a zone. So don't worry about it being to the exact, you know, dot on the line. Anything that comes within that range of the line is going to be considered average. All this is pretty average. Little above, little below. It's, pretty much following the average. Nothing to write home about. If it gets, I would say, about, 50% or more above the line, that's almost 100% above the line, or sustained below the line, again, 1 bar, I'm normally not going to be worried about, but just to point out a reference point, that's more than 50% below the line. 50% line would be half. Then I'm saying, okay, now we have a significant deviation from that volume moving average. So it's no longer in the zone of the moving average, a little above, a little below. No, it's way below, or it's way above, and therefore we're going to take note of it and say this is unusual volume behavior compared to what's been going on over the last 20 bars. Alright, so that is the basics of it. Now look at this. You see how we get such little eensy-weensy tiny volume down here. And let's see what our price is doing, of course. So this is very significant because we get a little such just minuscule volume here as this market is trying to go up. We got our cross here. We're trying to get something going to the upside. This is this is pretty flat, so that's just a first retrace after the cross. But there's no volume to support it. It's all below the moving average, and some of it's way below the moving average. And so we would look at that and just immediately, because we have this reference point here with the moving average of volume, we can see, get my lines out of there, wow, that is really pitiful volume. That is sad, sad, sad. There is nothing, there's no energy behind this. There's not a lot of people saying, oh, I'm buying this, I'm buying this. There's no participation. There's no market participation here. Then when we finally get something, that's we get something that's significantly above the moving average, 50% or more. It's actually about 100%, because from there to there is 100%. That's about another 100%. Well, now, what is price doing at that juncture? Well, let's get this off of here and look. Whoops. Boom. It's moving down. So very, very, very little volume on the up move and very big volume on the down move. And by drawing that line in there, or having the chart just draw that line, it becomes immediately apparent. Again, this is one of the issues where people say, I'm having a hard time. How much is a lot? How much is a little, Barry, when you talk about a little or a lot? Okay, this is exactly how I'm defining it. In relation to this moving average, anything that's 50% above it or below it, we're considering a deviation from the average. That's either a little or a lot. Then you look at what price is doing at that point, and here it's going up, no confirmation. Here it's cranking down, tons of confirmation. This is bearish. Comes right into our moving averages, cluster of the moving averages, the 50 and the 100. It pinballs for a little bit. Low volume, not surprising because we're going into a pinball pattern. Consolidation patterns are generally low volume patterns. Okay, and then it comes out of this, another cycle high, and boom, our next big volume bar, which is again 100% over the moving average, is to the downside. Our next one is again to the downside. Boom. So these big volume bars are coming into the downside. Well, now we've crossed the line in the sand, which is our 50-period moving average. And so now we're looking, to the downside. In general, the structure of the market has changed. All right, this is a gap, and usually on gaps you get these big volume bars too. Let's look over here. And what we have over here is basically, this is all pretty average. Actually, all of that's pretty average stuff. That's above average. Again, that's to the downside. This is all pretty average stuff. This is below average. It's well below average. And what's happening at that time? Well, during this time, we're having an upcycle, a half cycle to the upside. So this move up, actually this whole thing is consolidation. But as we're moving back up, again, we're moving against the trend. The trend now is officially down. So we're moving against the trend. We're going up on a half cycle, but volume comes out. So this, let's just review this and give you a little more commentary on it. This part and this part, really, what are they telling you? Nothing. 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 There's nothing here that's really giving you any clue. It's not giving you any additional information. So here volume is neither confirming nor is it contradicting any trade that we might have. It's just saying, yeah, volume's about average. See, remember the basic principle of trading with our indicators. We like to trade extremes. We don't like to trade things that are average or the median. We like, it's like the rubber band trade. You want to trade when things get to the end of the statistical bell curve, when things are not normal. When things are normal, that's the worst time to trade because anything could happen. You do not have odds on your side. Right here, this is all normal market volume. There's no odds on your side. This volume is not helping you or telling you anything special at all. So this volume spike is just telling you that that's a probable cycle low, which it is. Again, it's not worth much, but that's what it is. This, though, is telling you something new. So this whole time here, again, this is telling you, okay, moving to the downside. But this whole time, really not much helping you until you get here. Then we're saying, yes, retrace on low volume. Oh, ding, 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 alert, alert, alert. That is important because the market is actually trying to go up a little bit. But again, it's counter trend. It's against the intermediate trend. And it's on really low volume now, and we get a little double top here, which is great. So now we're saying, yes, I like this. We even get a little spike, high reversal bar here. So this becomes a higher probability trade and works very nicely. And then after you get in the trade, confirmation comes with this bar, comes with this, and you also get, now look what happens though. Let's move over to the right here. See, now your line is going to change. So your reference point is going to change. Because more volume comes in, the line gets higher. So in order for you to get an unusual situation where you get a spike in volume, it's got to create even more volume. Okay, So this produces a volume spike to mark the cycle low. Okay, we come back down to retest the low, actually kind of a couple times here. A little less volume, but again, it's not really telling you a whole heck of a lot. It's kind of in that range. When you take all these bars together, you got some that are a little below and a little above. That's a big spike. This now, because the bar has, or the moving average has gone up so much, now it's all about in the same range. Okay, so that's about as simple as it can be. We'll look at one more example. Okay, here's an interesting example. Let's see if we can even move our chart back a little bit. So, yeah, gosh, we can do this all day, but let's just start from here. So we had a little downtrend here. We come back up. 50 MA kind of goes flat. Price consolidates. And basically, as you can see, the volume moving average comes down. Volume's very, very low. Very low. So that is one thing to expect, that when volume gets very low, we can, not always, but we can be going into a consolidation pattern. Again, it depends how long it lasts. Long consolidation patterns tend to have low volume. Short low volume periods tend to be retraces. Now here is where it starts to really pick up significantly. And this is very, very interesting, because we get a nice half cycle coming up here, which really amounts to this. And so that would indicate that, golly, it looks like we're going to break to the upside, because we get a lot of volume coming in here. Let's bring our vertical bars in here. Okay, boom, boom. And we actually have a gap here, and we do gap up. But then, the very next bar, we get a hook on K, a cross of K and D, and we start coming back down. Now we come back down, and volume goes back down. Clear, so basically, if we're going to draw our little rectangles, this kind, you can't even do a rectangle on that one, really. So it's from there to whoosh, and then, put on the brakes, bonk. So why do I show you this? What does this mean? Well, I show it to you for a couple of reasons. Number one, when this happens, the 50 MA is flat. So really, there's nothing telling us what's going to happen here. And one of our rules is when the 50 MA is flat, it's best to stay out of the market. And this is part of the reason why, is that there's no question in my mind that this volume increasing here would tell a lot of people, and including us, that, hey, we might break out to the upside here and get something going to the long side. That does not happen, obviously, and the 50 MA being flat is just a non-entity. It doesn't really tell you to go long, doesn't tell you to go short. And this is why we say it's usually best not to trade when the 50 MA is flat. So I show you this because I want you, maybe you don't hear this, but I hear so much about how volume is the, next to price. Volume is the most important thing to help you trade. And again, I just do not adhere to that personally. For me, it's important and it is helpful, but it's just one more piece of evidence. No more important than the cycle indicator, no more important than the 50 MA, no more important than mom and dad, no more important than support resistance, no more important than the next higher time frame. And as I say about all of them, each one by itself is pretty useless. And this is an example of how volume could really lead you astray. And I wouldn't be surprised if there were a lot of traders watching this who traded this to the upside saying, oh, here comes our big surge of volume, go long, and got killed. Or at least hurt. Okay, having said that, then, this is average volume here, then the market really picks up. And we get a big move of volume as the market moves down. So now volume is confirming what's happening. But here, it's kind of messing you up. Okay, but again, the point is, this volume is helpful because it's aligning with the other indicators. This volume pattern is not helping because it's not aligning. You're trying to depend on one thing alone, and that is not a good policy. All right, so that's it. Again, using the moving average on volume is quite simple. That's all that I use it for. And so now we're going to move on. And in the next video, we'll be talking about the second indicator that I use for volume.